As a director, one of the most important decisions you will make is how to pay yourself as tax efficiently as possible. I'm a qualified accountant and experienced tax advisor. This video is an important update to one that I made last year and which lots of you found useful because we're seeing some major updates to national insurance in this tax year, which will have a huge impact on the amount of national insurance that companies have to pay. This video is kindly sponsored by Revolut Business, an app that helps busy business owners manage their finances in one easy to use platform. So first of all, let's cover the thresholds and the rates that you need to know to make sure that this video makes sense. So first of all, national insurance. National insurance isn't strictly a tax, but it is compulsory once you start earning over a certain amount. So it does work in a similar way to tax. So the lower earnings limit is £6,500, and that means that you have to earn at least that much to be able to qualify for certain state benefits like the state pension. We've then got the primary threshold, which is £12,570, and once you start earning over that, you need to start paying national insurance. Then the secondary threshold is £5,000, which means that once you start earning over that amount, your employer needs to start paying national insurance. And that used to be £9,100. So that's one of the biggest changes that we saw in the budget, and so it's one of the biggest changes this tax year, because it means that employers now need to pay national insurance from a lower amount. So employment costs are increasing significantly for employers. We've then got income tax, but the bands and the rates for income tax haven't changed, but that has resulted in fiscal drag, which basically means that people are earning more thanks to inflation, but the income tax bands haven't increased in the same way. So more and more people are being pulled into the higher and additional rates of tax. So in that way, fiscal drag is very much like a stealth tax, because people are paying more tax without being told that they're paying more tax explicitly by the government. So just as a reminder, you can earn up to £12,570 before you have to pay any income tax, and that's known as your personal allowance. Then the next part, up to £50,270, is taxed at 20%. And then the next part, up to £125,140, is taxed at 40%. And then anything that you earn over £125,140 is taxed at 45%. And your personal allowance starts to get tapered away as soon as you start earning more than 100k. Then we have dividend tax, and the bands are the same as income tax, but the rates are different. So for dividend tax, the rates are 8.75% for the basic rate band, 33.75% for the higher rate band, and then 39.35% for the additional rate band. Then moving on to corporation tax, companies pay corporation tax between 19% and 25% depending on the levels of profit that they make. So if you have a company making profits of less than £50,000, then the corporation tax rate is 19%. And then if your company's making profits of over 250k, your company will start to pay corporation tax at the main rate of 25%. And then if your profits fall somewhere in the middle, you'll pay tax at a marginal rate that will fall somewhere in between. And importantly, in this video, we're talking about directors who are also shareholders in their company. If you're watching this video, chances are you are a busy business owner and you know how chaotic it can be handling multiple business accounts and platforms. So before we talk through the strategy itself, I want to talk to you about Revolut Business. Revolut Business provide a quick and effective way to manage and streamline all of your business finances through one business account. One of the most useful features I discovered with Revolut Business is that you can connect your accounting software such as Xero or QuickBooks to the app for full visibility over your financial information. The app will automatically pull categories and labels and push reports and receipts back to your software, minimizing the time you spend on admin. You can also have full financial control with corporate cards and custom spending rules. So if you employ people, you can issue physical and virtual cards to team members instantly through the app so that they can make their own payments within their spending limits. So if you're a busy business owner, give it a go by using the sign up link here also linked in the description below. And even better, if you add money to your account by the 31st of May, you will receive a £200 welcome bonus. New UK business customers only, subscription fees and terms and conditions apply, and some features are only available on certain plans. Now let's get into the strategy for extracting your money in the most tax efficient way. So what salary should you pay yourself as a director? It's important to take a salary over the lower earnings limit so that you can qualify for certain state benefits like the state pension. And it's also important so that your company can make the most of the corporation tax deductions that are available on salaries. So the optimal salary to pay yourself as a director is £12,570. For you as a director, that means that you don't need to pay any national insurance because you're at the primary threshold. It also means that you don't pay any income tax because you're within your personal allowance, and it means that you get to accrue those state benefits. The company does have to pay employers national insurance, and it's much more than it was last year because that secondary threshold has gone down to £5,000. But the other change that's happened is that the employer's national insurance rate has increased from 13.8% to 15%. That means that the national insurance payable by the company is £1,135.50, whereas before it would have been around £479. So you might ask yourself why you wouldn't just pay yourself £5,000 as a director and skip the employer's national insurance altogether. But the reason is that the company will receive a corporation tax deduction for your salary and for your national insurance. And that actually completely offsets the national insurance payments that the company has to make on your £12,570 salary. So just to show you how that works, let's compare the national insurance deduction that the company would get for that element between £5,000 and £12,570 with the national insurance liability of the company. So first of all, the company will receive a corporation tax deduction for the national insurance that it's paid for you as a director, which was £1,136. And at 19%, the deduction is therefore £216. And then secondly, the company receives a deduction on your full salary. So for that bit between £5,000 and £12,570, it's £7,570, and at 19%, the deduction for the company is £1,483. So the total additional corporation tax deduction that the company will receive for that bit that you're earning over £5,000 is £1,654, and that offsets the company's national insurance liability. So that's why £12,570 and not a penny more is the optimal salary for a director, because there's no income tax, there's no employee's national insurance, and the employer's national insurance is completely offset by the corporation tax deductions that are available. It's also why you wouldn't just pay yourself a huge dividend as a director, because you miss out on the ability to accrue those state benefits, and you also miss out on the corporation tax deduction that a salary provides, because dividends are not tax deductible, but we'll cover that in a minute. A quick ask from me before we cover dividends: if you're enjoying this video, then please do hit the subscribe button for more tax and personal finance content. How much of a dividend should you take? A salary of £12,570 is not going to be enough to fund all of your needs, because it's only around £1,000 a month. So anything else that you take out of your company should be taken as a dividend. Dividends don't receive the same corporation tax relief as salaries do, because they are extracted from post-tax profits. So there's no deduction available for them. But they are still more tax efficient than taking a huge salary, because the dividend tax rates are lower than income tax rates, if you remember the rates that we spoke about earlier. Plus, this tax year, you do have a £500 tax-free dividend allowance. That used to be higher because around 8 years ago, you could take £5,000 of dividends before you paid tax on them, but it has been slowly decreasing. But it does mean that you can take £500 out of your business tax-free as a dividend, and then the 8.75% tax rate applies. So you can take a further 37.2k out as dividends, and in our example, you'll have 8.75% of tax to pay on those dividends, which takes you to a total remuneration of £50,270. And then you would have just paid £3,255 of dividend tax on that level of dividend that you've extracted from your business. Now let's just quickly summarize your total remuneration package and the taxes that you've had to pay on it. So to summarize the remuneration that we've been through, as a director, you've taken a salary of £12,570, and then you've taken dividends of £37,700. The only tax that you've paid as a director is around £3,300 on your dividends. The company has paid national insurance, but it's also received a corporation tax deduction for that national insurance and for the salary that it's paid you, and it's paid corporation tax on the profits that those dividends were paid from, because remember, dividends are paid from post-tax profits. So in total, you as a director and your company have paid around £9,000 of taxes on your remuneration of £50,270. Now let's quickly cover a couple of caveats that you need to remember when planning your remuneration. The first thing to consider is the national living wage. Directors are not automatically employees of their company because they are actually office holders. But if you have a contract with your company that makes you a worker, then you might have to pay yourself the national living wage, which, assuming you're over 21, is £12.21 an hour. So depending on how many hours you work in your business and whether or not you have one of these contracts in place, you might have to pay yourself the national living wage, which might mean taking a higher salary than the £12,570 that I've been talking about in this video. Secondly, dividends. Dividends are paid from accumulated realized profits, which means that you need to have sufficient distributable profits in your business in order to take a dividend. So just remember that when planning your remuneration strategy. So that's my suggestion for the most tax efficient way to extract money from your business as a director. It does assume that you don't have other income sources and money coming in from other places. If you do, then it might change how you structure the remuneration from your company. Also, use this video as a guide and for education. It's really important that you do speak to a tax advisor before planning your own remuneration strategy. Thank you for watching. Subscribe if you haven't already, and I will see you next time.